everyone. Hi, I'm Shira Zimmerman, Investor Relations Manager for the Trendlines Group. With me today are Steve Rhodes and Todd Dollinger, Chairs and Group Executive Officers of the Trendlines Group, and Chaim Brosh, Trendlines CFO. They will present business updates and a financial overview of 2022 and answer questions at the end. We're also pleased that Dr. Idit Goldberg, the CEO of our portfolio company, Escala, will join us today to briefly introduce her company. To submit a question to our management team, you can use the question and answer function in the conference call. Please note that this presentation may contain comments that constitute forward-looking statements which involve risks and uncertainties. Examples of forward-looking statements include descriptions regarding the intent, belief, or current expectations of the company or its officers with respect to future results of business operations and financial condition, industry, environment, and future events and plans of the company. Such forward-looking statements are not guarantees of future results, performance, or achievements. Actual results, performance, or achievements of the company may differ from those expressed in the forward-looking statements as a result of various factors, such as known and unknown risks and uncertainties, and assumptions, including those risk factors discussed in Trendline's offer document dated 16 November 2015, and in the company's filings on SGXnet, which you are encouraged to review. By their nature, forward-looking statements involve risks and uncertainties because they relate to events and depend on circumstances that may or may not occur in the future. In light of these risks and uncertainties, actual events resulting in developments could differ materially from those expressed or implied by the forward-looking statements. The statements represent the company's or its officers' views only as of the date they are made and should not be relied upon as representing the company's or its officers' views as of any subsequent date. The company does not assume any obligation to update any forward-looking statements. These are the topics we'll be covering today. As part of our portfolio update, we'll be hosting Dr. Idit Goldberg, the CEO of Escala Medical, who will give us a short presentation on her company. Finally, please note all monetary values cited are in US dollars unless otherwise specified. I will now turn the presentation over to Todd Dollinger, Chair and CEO of the Trendlines Group.
Thanks, Shara. For those of you less familiar with Trendlines, here's a quick snapshot of who we are and what we do. Trendlines invests in two areas, agri-food and medical technologies. We invest in these fields in support of our mission of investing to improve the human condition. We have 15 years experience in funding and building early stage companies from seed to exit. Today, we have a portfolio of over 56 companies at various life cycle stages. Of those, 20 or more advanced or more mature companies, meaning that they've achieved meaningful development milestones, and some are already at commercialization stage. To date, we've taken 2 of our portfolio companies public, and we've exited 10 companies. Focusing here on our portfolio companies, note that despite the uncertain situation of the world markets today, many of our companies reported business achievements last year. These achievements reflect a maturing portfolio with follow-on capital successfully raised by companies, often with larger raises and at higher valuations. Achievement of significant milestones is, we believe, a mark for the exits ahead. As well, this points to the importance and the value of the fields we invest in, medicine and agri-food. As it's a challenge for investors to review all of our companies at any given moment, we urge you to take note of the achievements of our more mature companies, companies that are ramping up and achieving significant milestones. It's the sum of these amazing stories that truly is the value of Trendlines. Within this challenging market and political atmosphere, many of our portfolio companies have completed raises this year and last year, including some for substantial amounts, again, indicating a maturing portfolio. Early in the year, Vensica completed a $19 million raise with MERS Therapeutics, the urology medical device company Laborie, Trendlines, IBI Venture Capital, and others in this significant funding round. Phethalon, a company that produces natural food colors via biological fermentation and sustainable processes, announced a $14.5 million round led by DSM Ventures, the investment arm of the food giant DSM. Portfolio companies Setbone and Arcuro were among the companies that closed funding rounds in 2022. And both Phethalon and our robotics company, Metomotion, signed significant collaboration agreements. Phethalon with DSM, the giant food company, and Metomotion with Ritter, a company developing greenhouse technological solutions. Escala Medical announced FDA clearance, paving the way for entry into the U.S. market for its non-surgical solution to pelvic organ prolapse. We'll hear shortly from Escala's CEO, Dr. Edith Goldberg. And we also note further that Limaca Medical received FDA breakthrough device designation for its precision endoscopic ultrasound biopsy device. Liberty, a company that's developed a digital dialysis clinic for home dialysis, also received FDA clearance toward the end of 2022. These three companies are now in the process of raising additional funds for their growth. Some 7 companies launched clinical or field trials to advance their regulatory and commercial goals. Every successful clinical trial brings our companies to increased valuations, towards sales, and on the road to exit. I'm now going to turn the presentation over to Steve Rhodes, Chair and CEO of the Trendlines Group, to review aspects of our portfolio.
Thanks, Todd. We believe strongly that the best way to understand Trendlines and the value we have created is by looking more closely at our portfolio companies. That's where the value is. To that end, we'll spend the next few minutes highlighting some of our portfolio companies for you. Of our 56 companies, 23 are in the agrifood sector and 33 in the medical devices sector. 17 companies are defined as revenue stage companies already selling their products in the market. In another sign of the maturing portfolio, numerous companies had record sales last year and expect sales to increase further this year by as much as 2 or 3 times their 2022 results. About 20 companies have a strategic partner on board. 8 of our companies, medical technology companies developed in our medical incubator in Singapore, are consolidated on our financial statements. In our last call, Dr. Halim Jubran, the CEO of Phytolon, spoke to our shareholders about this exciting business that we believe could ultimately be worth more than Trendlines itself. Phytolon continues to make progress in their quest to produce completely natural, stable food colors using a fermentation process. In 2022, as Todd mentioned, Phytolon announced the completion of a $14.5 million investment round, a remarkable achievement for such a young company. Phytolon has captured the attention of industry leaders and has completed paid pilots with numerous food companies. In addition, the investors in the $14.5 million round included the global food giant DSM and the synthetic biology leader Ginkgo Bioworks, as well as VCs, including Cebus, Millennium Food Tech, and EIT Food. We look forward to Phytolon's continued progress. I'd love to now take the next hour to describe for you each of our 23 great companies, but time doesn't allow me to do it. So what we're going to do is sample the progress that has been made by 4 additional outstanding agri-food companies that represent the high caliber of all of our companies in our portfolio. All 4 companies have completed investment rounds to expand their capabilities, and all have strategic collaborations with multinational corporations already signed or in the offing. In 2022, FruitSpec broadened its sales base and launched an important new product. The company is making great strides in the food supply chain realm and expects to triple revenues this year. Metomotion, with its strategic collaboration with Netherlands company Ritter, ramped up production and has begun sales of its AI-based autonomous robot for greenhouses. AgriScout has continued expanding its customer base, adding AECI in South Africa, among others, and deepening its strategic cooperation with DJI, the world's leading drone company. The company was also recently accepted to the highly prestigious Google for Startups program. Finally, Viaqua is poised to launch its first product and is expanding its pipeline by adding additional diseases and new species, including barramundi, in cooperation with a Singapore partner. These 4 companies and Phytolon represent a small bite of our 23 agri-food companies. I'm really sorry there isn't time today to tell you about the other 18. So I'll just hand the mic back to Todd for an overview of our medical companies.
Thanks, Steve. We're going to take a bit of a commercial break here, and we're going to invite Dr. Edith Goldberg, the CEO of Escala, to talk about her work and to talk about the work of the company. So Edith, over to you.
Thank you. I'm glad to share my screen with you. Okay. So good morning, everyone. My name is Edith. I'm the CEO of Escala. It is my pleasure to introduce you to our company and first incision-free repair solution for pelvic organ prolapse. Prolapse affects 3.5 million women in the US alone every year. And this happens when the bladder and other pelvic organs slip down from their normal position and bulge into the vagina. And you can only imagine the impaired quality of life and suffering this involves. Now, usually it is recommended that treatment should start early. However, this is not that straightforward with prolapse, and here's why. 3.1 million out of the 3.5 million women do not have any repair solution, only support. Now, the other 400,000 women are at an advanced stage of the disease and can undergo only surgical procedures. So basically, for more than 3 million women, they are left to deal with their discomfort, pain, and incontinence. And this represents a market exceeding $3 billion in the US alone, where Escala is actually the only alternative. So why is surgery not offered to more patients, even though it is the gold standard? Well, the procedure involves dissecting into the pelvic floor to expose the ligaments attaching the vaginal wall. And as with any surgery, it involves hospitalization, it is prone to complication, and requires a lengthy recovery. We've created Apix. Apix is a repair solution that harnesses the benefits of a surgical repair, but without the complication. And this is done in an incision-free approach. And when presented side by side, I believe that the results are obvious. So our first device is now FDA cleared. I'm sorry, I'm here. Sorry about that. This is how the Apix procedure works. So the applicator delivers an anchor and suture through a needle into a ligament. The surgeon introduces the applicator's tip to the correct location in the vagina, and the anchor is placed with a controlled squeeze of a trigger. The applicator is retracted, and the button-like securing element is threaded and fixed in place, and then the sutures are tied and cut. And after healing has occurred, the sutures dissolve and the buttons are naturally expelled, leaving the vagina device-free. So this is essentially a 5-minute procedure, replacing surgery. And our device is now FDA cleared. We've started commercialization in the US, and so far we have great interest and feedback from users. The first in-human clinical study showed meaningful improvement. There were no device-related adverse events or bleeding. Most patients did not ask for any painkillers, and the entire procedure took 5 to 8 minutes to complete. And we believe that this can actually transform a hospital-based procedure to an in-office setting. So for most of the 3.1 million women, we may actually have a solution. And we have a wonderful team that brings years of medical and business experience. And in addition to our board members that you already know, I would like to especially mention Dr. Bob Auerbach, chairman of our board, who's a urogynecologist from the Yale School of Medicine and the former president of Cooper Surgical. So prolapse is generously reimbursed. We design Apix for single use with a selling price of $1,100 to $1,500 per kit, and that reflects an 80% gross profit for the company when sold directly. We raised about 4.7 million to date, and we seek additional 8 million that will allow us to expand commercialization and conduct additional post-market clinical studies. And I'll end up here with just a few testimonials. Escala has given me hope as we hear from patients that write to me every week. And also Dr. Mike Ingber, who was the first user of APIX in the US, that believes that our technology will actually be a game changer in the field of urogynecology. So I'll leave you with that, and thank you very much.
Edith, thank you. A great presentation, great overview of what we're doing here. Escala Medical to us means many things, not the least of which is it so clearly addresses our mission of investing to improve the human condition. And Edith's a special person for us. Edith joined us as an employee of the Trendlines Group, responsible for our medical deal flow. She actually brought us the idea for investment into Escala. And when we looked at advancing the company further and bringing a new, strong CEO into the company, Edith raised her hand at the same time that we were pushing her. So just a great addition to the company. And the company's at an amazing stage, just having reached FDA, having a great CEO and a brilliant chair who's an OBGYN who understands the area brilliantly and was the CEO of a major medical device company in America. We'll look to great things here. It's a company that's currently funding, and we look forward to talking to you more about the success of Escala in the months and years ahead. Again, thanks, Edith.
Thank you.
Well, we're going to move on and talk about a few of our other companies that we're proud of. Really here now on the Medtech side of our business. And beside Escala, we're going to focus today on 4 other important medical device companies from our portfolio. 3 of them have achieved regulatory clearance, and 2 have already launched sales. Arcuro has FDA clearance and CE mark and has launched sales in the US, Latin America, and beyond. The company is working with some of the most important leaders in sports medicine today, and its meniscus repair device is clearly superior. Faster, easier surgeries are performed with the Arcuro device. Arcuro, under the guidance of our CEO and founder, Lee Ranone, and with the support and leadership of our chair, Robert Bash, who we brought into Arcuro, are really moving to bring this company forward. And one of their greatest additions is our new medical director, Dr. Phil Davidson. And with him, joining him on the scientific advisory board, one of the leaders in sports medicine in America today, Dr. Ken Zaslav. And today, they and others form up our company's scientific advisory board. Again, leaders in the sports medicine field, helping to bring Arcuro forward to success. The company has generated tremendous interest in the medical device community in the US and beyond. Similarly, ST Stent has FDA clearance and to date has done over 300 surgeries in the US, with these patients having been treated with the arch sinus stent. As is the case with Arcuro, we often seek out world-class chairs for our portfolio companies. And that's certainly the case here with ST Stent. We brought in, we're pleased to say, Mike Berman, who was the president of Boston Scientific Cardiology. And Mike today serves as the chair and also really as the commercial leader of this company. And Mike's decades of experience as a top executive have dramatically increased the value of ST Stent through the strength of his leadership and his commercial contacts around the world. Liberty, which allows for dramatically improved safe home dialysis for the growing population of renal failure patients around the world, received FDA clearance right toward the end of last year and is now poised to raise funds and to head into commercialization of their product, a product that will truly improve the lives of many patients who will be able to do dialysis at home safely and efficiently and really free up their lives to do more things. And Liberty's chair is a former CEO of B. Brown USA. an old friend of Trendline's and one of the leading names in the medical device industry worldwide. Finally, I just want to mention Pregnantech, another femtech company, another company dealing with the often ignored area of women's health. Pregnantech is a game-changing device to prevent preterm birth. The company's launched clinical studies and has successfully brought 4 babies to term with no adverse safety issues. We have an amazing testimonial on our website from one of the first patients to have used the device. She clearly believes that we made, through our work with Pregnantech, a change in her life. Pregnantech and Liberty are just clearly examples of our work, which is all about investing to improve the human condition. And with that, I'm going to turn things back to Steve to begin a review of some of our financial information.
Thanks, Todd. In the last 15 years, our total portfolio value that's been created, including cumulative exit proceeds, has reached $139 million as of the end of 2022. It's important to note that this cumulative value does not include the value of our consolidated Singapore portfolio companies. At the end of 2022, the fair value of our portfolio was $89.7 million as compared to $83 million at the end of 2021. This is more than an 8% increase in value, despite the fact that we wrote off our schematics investment during 2022. The actual increase in the remaining companies was much larger. This is a very important slide, and I want to call your attention to it because it represents new information that we're providing to our investors and shareholders and others interested in Trendlines for the first time. Balancing our desire for greater transparency with our need to protect the sensitive information of our portfolio companies, we are now providing information on our portfolio value through clusters-based valuations in our reporting. In this table, you can see the 12 clusters with the total value of Trendline's share in each of the clusters based both on the value in our audited financial statements and the value based on non-IFRS information. In the past, we've been asked to disclose information about the valuations of our individual portfolio companies, and we've always resisted that. In order to give, though, a deeper dive into the valuations of our portfolio, we've adopted this cluster approach. Each cluster contains between 3 to 6 portfolio companies, and we disclose which the companies are in each portfolio, both in the announcement we made in our annual report and later on in our presentation today. With this additional information, we're now giving shareholders a new prism through which to view our portfolio and its value. You can see the value of clusters of 3, 4, 5 companies, something you could never see before. In the same way that management uses the non-IFRS information, we hope that you will be able to use this information and find it an important and interesting tool. As you can see in the presentation, the overall non-IFRS value of our portfolio at the end of the year was $146.6 million. This is 63% greater than the $89.8 million IFRS value reported in our audited financial statements. The difference is that the non-IFRS values were calculated by adding in the values of our consolidated companies, which otherwise don't get value in our financial statements, eliminating the discount that is applied when a company raises funds with preferred shares. Since over our experience in our 10 exits, the impact of the preferences has been very small or non-existent compared to the discounts that are used for IFRS reporting purposes. And finally, we've used the capped valuations of safe rounds as a substitute valuation. Many of our companies have raised significant capital through unpriced rounds, safe rounds, but those rounds all have capped valuations, and we've used those caps as a substitute for the valuations. For more information about the non-IFRS values, it's important to take a look at the notes and disclaimer provided on slide 25 of this presentation. Going ahead, as we've shared with you in the past, in the attached slide, you see that upon exit, the average value of our exits has been roughly 440% 440%, 4.4 times greater than the book value, the IFRS value prior to exit. Assuming past experience provides some indication of the future, this number gives a strong indication of the potential for our future exits, and we believe shows, again, the tremendous hidden value in our portfolio. During 2022, 34 of our companies raised a total of $92 million, with a larger raise amount than ever before. This is a record of all time, as you can see in the chart. And you can see the increasing amounts of capital raised over time consistently really is an indication of the maturing of the portfolio and the fact that the portfolio is getting closer and closer to exit. It's important to note that this includes mature companies that are part of our venture funds. I'll now hand over to Chaim Brosh, our CFO, for an overview of our financial metrics for 2022.
Thank you, Steve. Here is an overview of a few of our key financial metrics. Our portfolio value increased by 8.1% compared to December 31st, 2021, despite the write-off of schematics as previously noted. Our total equity decreased by 6.5% and our NAV per share decreased to 11 US cents per share. We reported a net loss for the year of $15.2 million compared to a $6 million gain last year. The main reason for this loss is the write-off of expected proceeds from the schematics exit, as we announced a few months ago. In January 2022, we announced an agreement with a group of current and new investors to invest a total of $15 million in 8 quarterly tranches at a per share price of 12 cents into trend lines. To date, we received almost the whole of the first 5 tranches investments. The total assets decreased by approximately 10.8% from $121 million as of the end of December 2021 to $108 million as of December 31st, 2022. This was mainly due to a decrease in cash and cash equivalent of $9.7 million, a decrease on contingent consideration of $5.9 million, a decrease in short-term deposit of $2.2 million, which was offset by an increase in investment in portfolio companies of $6.7 million. Our long-term liability amounted to approximately $5.2 million as at the end of 2022, a decrease of 35% as compared to December 31st, 2021. Our long-term liability represents approximately 43% of our total liability as of the end of 2022. Total income decreased by approximately $13.7 million from a gain of $16.1 million in 2021 to an income of approximately $2.4 million in 2022. The loss in fair value of investment in portfolio companies was $2.5 million in financial year 2022, as compared to a gain from change in fair value of investment of $9.2 million in financial year 2021. In 2022, there was an increase of $13.6 million in the fair value of various portfolio companies. The increase in fair value of investment in portfolio companies was offset by a decrease of approximately $7.7 million in the fair value of other portfolio companies and a write-off of schematics of approximately $7.9 million as a result of the acquirer discontinuing the marketing of the product of schematics, as stated in the company announcement dated July 14, 2022. Income from services to portfolio companies comprised of approximately $700,000 received as an overhead reimbursement for our portfolio companies and approximately $1.9 million value of the non-cash benefit received from the Israeli innovation authorities. In view of the above, loss before tax benefit in 2022 was approximately $17.2 million compared to a gain of approximately $2.6 million in 2021, mainly due to the losses from the change in the fair value of investment in portfolio companies as compared to the gain in this item in 2021. I'll hand the presentation back to you, Steve.
Thanks, Chaim. During 2022, we reviewed our strategy and focus to realize our potential through focusing on our more mature portfolio companies. We made an important shift in the strategy and operations of the company by suspending investment in new companies. We've stopped establishing new portfolio companies, and in accordance with that decision, have reduced staff. We aim to use our capital, both human and financial, to maximize the potential of our remaining companies. And we're seeing that as the companies raise more capital, increase their sales dramatically, and move toward the exit. By providing additional information, reporting information, which divides up the portfolio and its value into clusters and adds non-IFRS information, we're offering more clarity now and user-friendliness, as I already mentioned, in understanding the dynamics of our portfolio. If you take a look at this slide, it shows you the 7 clusters of our medical device portfolio, and it also gives you the names of the companies in each of those clusters. Take a look, for example, at the urology and women's health cluster. We just heard from Dr. Goldberg of Escala. The IFRS value in our books of this cluster is $11 million, while the non-IFRS valuation of the group is $27 million, more than double the value. Pandemic and the last year have highlighted that more than ever, our health and our food are essential systems in which the world must invest to ensure well-being and quality of life for all. Our portfolio companies address these needs. They are urgent today and will continue to be urgent tomorrow. And here you can see our agri-food portfolio clusters divided into 5 clusters. And again, take a look at the digitization and robotics. There are 5 companies mentioned. 4 of the 5 companies are already selling product and expect to have dramatic increases in sales this year. The IFRS value of the group is about $8 million. The non-IFRS value is roughly double. And we believe that these valuations are important in understanding the overall value of the portfolio and of Trendlines itself. When you look at the portfolios, it's important to note how the non-IFRS cluster values were established. And please read this slide at your leisure to understand better how we calculated those non-IFRS values. There's a strict methodology applied. It's not just whatever Todd decides it should be, or Steve, for that matter.
Thank you, Todd, Steve, and Chaim. To remind our listeners, if you want to submit a question, use the question and answer function in the conference call. We'll be addressing questions in a minute.
Sure. I think that before we turn to the questions, there's probably one question that's in the minds of many of our listeners and many of our shareholders, and that relates to the news that's been coming out of Israel in the last few weeks and months about the political situation here. Israel, unlike many democracies of the world, does not have a constitution. The result is that there is no clear delineation between the powers of the 3 branches of government, and this has led in recent weeks to an unprecedented crisis which has been reported around the world. We call on all parties within Israel to work to draft a constitution that will ensure the stability of the nation. The startup nation, Israel, has been characterized since its formation almost exactly 75 years ago by an entrepreneurial, can-do, argue and then negotiate spirit. This spirit must be applied to the issue of governance so that the next 75 years will be even more productive for our nation and the world. At this time, we see no impact on our business or that of our portfolio companies, but we continue to monitor the situation and will act as appropriate for all.
Okay, so that's just to answer anyone who was thinking of asking what's happening in Israel. Okay, we have a few questions here. They're kind of connected. So let's get right to it. What's the game plan for this year? How many exits are we targeting? Also, wouldn't it be better to be more selective of new companies that we invest in rather than stopping altogether? Ultimately, I think that the share price of the company would be much better reflected when there are high value exits and when the company starts making money and is able to pay a regular dividend.
Right.
That's connected to one of the questions that we received, which is when will shareholders see return from exits?
Oh, you packed a lot into there. Well done.
There you
Okay,
go.
so apparently this conversation is going to go on for 4 or 5 hours just on that question. I'm going to pick out a little piece of that and then we'll go from there. Interesting question about the new investments that we are not making today. We actually completed our new investments. I believe it was actually December 31 of last year. We made our last planned investment. And I think it's likely that, and I would never say never, but I think it's likely that we're really going to do a pretty good job of sticking to that in the near term. No, we have a large portfolio. We have 56 companies in our portfolio today. These companies are maturing. We have a larger percentage of more mature, more experienced companies today than we have ever seen. And we feel that to be most productive, these companies require more of our time, more of our effort in helping them mature and helping to bring them to revenues and helping to bring them before investors and the strategic partners that will acquire these companies this year and in the years ahead. Now, there was a question buried in there of how many exits we're going to have this year. So Steve will tell you exactly how many exits we're going to have this year, but I would say we're looking for a good year.
Before I answer the exit question, I'll just add to the question of investments. The comment was an interesting one. It was, shouldn't you invest in fewer companies, but not suspend the investment activity altogether? And that's certainly something that we discussed when we considered the new policy. But we're really focused on creating value for our shareholders in the short and intermediate term. And this will also tie into the exit question. And what we realized was that starting new companies eventually creates tremendous value for the company. We've seen how the value of the company has grown from nothing to, we've created $140 million worth of portfolio value over the years. But when we start a new company, it really doesn't contribute value for a period of at least 5 or 6 years, generally speaking, before we start seeing significant increases in value. And certainly the exits tend to take probably 8 to 10 years on average for companies. And so starting new companies today is not going to do anything, we don't believe, for our shareholders or for our share price and value in the short term, in the next year, 2 years, 3 years. And so we really want to focus on those exits. During the presentation, we mentioned how we have many companies that are in revenue today. And Todd talked about Arcuro. Arcuro has been selling. They sold last year. Their sales in the first quarter of this year are probably greater than their sales for all of last year. Similarly, on the agritech side, we have companies that are expecting to do sales of 2 and 3 times more than they did last year. Just one example I can give is a company called SoulChip, which in 2021 had $65,000 of sales. In 2022 had $500,000 of sales. And in 2023, expect sales of between $1.5 and $2.5 million. Companies growing like that, scaling like that, brings us, we believe, closer and closer to exits. We can't, of course, predict when those exits will occur. I wish we could, but they're not up to us. They're up to the market. They're up to the buyers. We can't force buyers to purchase companies. But I can say that with confidence that we are in talks all the time with the market. Todd was in the States recently speaking with major multinational companies and exposing them to selected portfolio companies. So we're pushing very hard for exits. And I think that we're going to see significant exit activity in the next couple of years, which will then enable us to distribute dividends as we've promised we would do. Do you want to add to that?
No, I think that's a great point. Our role is to advance the companies. It's to position them for exit. It's often been said that companies are bought, not sold. Now, that said, we put a tremendous amount of effort into properly positioning companies for sale and for sale at what we believe to be appropriate value-producing prices. And that's why we attend conferences. We visit with our strategic partners around the world. In fact, I'm off again tomorrow on a trip that'll take me to Canada and Singapore. And we'll be meeting with some of the biggest medical device companies in the world during the course of these visits. That's the focus of our work. And today, with this maturing portfolio, we feel a great need to be spending more time with our maturing companies as we help them move toward the exit.
Okay, a question in a different direction. Looking a little bit back, what has management learned from the last few exits, namely Stematics and Apifix, where we had to write down the value drastically for the former and the poor share price of the acquirer in the latter? How will things be done differently for future exits?
Well, let me comment first of all on negotiations, and then Steve will add, no doubt, some thoughtful comments about how we conclude these matters. It wouldn't be a secret to anyone in the industry or anyone in the business of investing to say that as we look toward exiting companies, as we enter into negotiations with multinational corporations, these conversations inevitably always begin with what will be the size of the check that's to be written at closing. This is it. It's a cash focus. With small and mid-sized acquirers, there is often great interest in our taking their stock as part of that exit. With the larger companies, far less likely to happen. They will tend to want to pay cash. They have access to large amounts of cash. But as these negotiations continue, and as we seek to, and I can't use the word maximize here because I can't say that's a goal, but as we seek to get what we believe is the proper value for a company at exit, once those negotiations have continued beyond the point at which we can't expect more cash at closing, then we look for other opportunities for bringing value through to our shareholders. And that's going to be in deferred payments, which may be milestone-based, it may be revenue-based, it may be stock-based. So the fact of the matter is, and again, I'm not giving away an industry secret here, is that it always starts with cash. And from cash, it moves to deferred payments. From deferred payments, it may move to equities. So the point and the focus remains the same. And are we prepared to take deferred payments and or stock on top of initial cash payments? The answer is yes, but don't tell anyone I said it.
But it's let me just make a comment, Chaim, and then I would like you to add something. It's a real challenge to value those royalty payments or earnout payments. And we have spoken about that and wondered, what can we learn from this? On the one hand, we're not only obligated to, but we want to disclose to our shareholders what we reasonably believe could be the values of those future of that future consideration. At the same time, we understand that there's a risk involved in that. Actually, in the case of Apifix in particular, I think that the initial estimations were probably quite good and quite conservative and accurate. What they didn't anticipate was the COVID crisis, which basically put all of the product launch of Apifix on hold for 12 to 18 months. So we really paid the price of that situation. I doubt highly whether we could have negotiated in a COVID clause into the contract before we knew that before we had ever heard the term COVID. But it's certainly something we will think about in the future in terms of how we report the value of those assets. Maybe you want to comment about how we do the valuations and what you think we might have learned from them.
Well, I would like to touch a bit on the process we did for the Apifix earnout. As we are doing for all of our assets, we are evaluating them on periodic basis by using a third-party expert on doing the valuation. But in this case specifically, we also measured ourselves and mimicked the liability that was written on the acquirer books, which is a public company. And our numbers were actually closer to what they booked as a liability. And into some of our surprise, they reduced the liability as a result of what Steve just mentioned. And because of that, we also reduced our assets. So I think the fact that we were able to to be very close in our estimations to what it was written on the acquirer company. And in this case, of course, it was a public company, so it was easier for us to evaluate, to see what the numbers are. But we are looking very carefully in all of our estimations, all of our assets, and maybe just to link it to what Steve presented before, the total value of our portfolio companies in our books of $89 million compared to a non-IFRS information, which is much larger. So I do think in all of our asset perspective, we are treating it fairly, accurately, and definitely not taking any aggressive approach on measuring them.
Thanks, Mark.
Okay, and a question in a different direction again is, how does the company foresee the current startup funding winter going? And how will the company position itself in the near to medium term?
So that's a great question, and it's one, of course, that we are very concerned about. The truth is that up until now, we have not seen a significant decline in investment activity in our portfolio companies. Our company, Viaqua, closed an investment round just 2 weeks ago. Another one of our medical device companies is closing a round this week. But it doesn't mean we're not concerned. We've encouraged all of our portfolio companies to both look at their expense structure to make sure that they can extend their runway on the one hand, and on the other, to begin their fundraising activities earlier, because we believe it could take longer to raise capital.
Yeah, it's a really interesting question. And I would say there are two key factors here that really address the inquirer's thought. One is, of course, the ability to raise, and the second is valuations. Now, Trendlines fits in a very interesting niche in the investment world. As you know, we don't raise money for companies at multi-billion-dollar valuations. We are startup specialists. We invest to create companies, and then we work on growing those companies. Now, we're also not typically raising money, and we've actually never raised money at valuations for portfolio companies, even in the hundreds of millions of dollars, much less the billions of dollars. So where does that put us? It means when you're talking about raises at valuations of $10 million, $20 million, $30 million, there is, in difficult times, less downward pressure on the valuations. As well, we see continuing availability of capital. That is most assuredly no guarantee of what will happen going forward, but take a look at what we've achieved during down years. And first of all, you see we continue to raise more money each year than the year before. This has been a constant thread for a number of years now, and the valuations are increasing. So who gets battered during these tough times are the companies that go out and raise at billion-dollar, multi-billion-dollar valuations. They wind up losing 80-90% of their value in some cases. We, on the other hand, in our niche, we see, generally speaking, on average, valuations increasing and the total amount of funding increasing. I realize that that's a bit counterintuitive, but those are what our numbers are. We anticipate a good year this year, even in these confusing market times and confusing political times internationally and domestically.
Happily, I think that same analysis applies to exits as well. During difficult times in the markets, multinationals tend to cut back on their acquisition activity. But when they say that they're cutting back on acquisition activity, what they're talking about are the multi-billion-dollar acquisitions, the mega mergers, where a $50 billion company will acquire a $3 or $4 or $5 billion company. When it comes to completing a product portfolio with an acquisition of $200, $300, $400, $500 million, historically, we've seen that sort of activity continues even when there's a general downturn in overall M&A activity in the markets. So even when it comes to exits, we feel that we are less at risk of seeing a downturn than the overall market.
We're well positioned for bad markets. First of all, take a look at where we invest. We're investing in food tech. We're investing in medical devices. A growing population, an aging population, these areas will continue to grow. We're not we're not working in fads, we're not working in trends, we're working in what we need every day for society to continue to be strong and to be healthy. We're very pleased that these things act in service of our mission, and we're very pleased that we anticipate continued growth. In fact, the kinds of exits that Steve's talking about, a very important point. Very pleased you added that to the comments today.
Okay, so I'm going to cut
There's
you.
just one other thing I want to add to that, which is that when we take a note, these things are actually referred to as tuck-in acquisitions, a smaller value. It's interesting, it continues.
Okay, so we have 10 minutes left in the session and we have 2 more questions. So I'm going to ask you to be a little bit shorter on your elaborate
I'm
answer.
always short.
Okay, we know that. Okay, the Libra Group has emerged as a major and controlling Trendlines shareholders at prices that are very favorable versus the IPO and placement price down in Singapore. What are their plans and intent in creating value that translates into raising stock price?
It's a great question. Libra joined us, I think, about 3.5 years ago originally. They've been a fantastic supporter of the Trendlines Group. Not only have they invested directly into the group, how much have they put in directly, Chaim? Do you remember? Is it 20?
Trendlines $20 million in Trendlines itself,
Okay.
$30 million in the portfolio company.
And each of those investments into Trendlines, although significantly below the IPO price, unfortunately, each of those investments was at a significant premium to the market price, reflecting their belief that the company was undervalued. As Chaim mentioned, not only have they invested significantly in Trendlines itself, but they've invested significant amounts of capital into our portfolio companies. And also they've taken a large position in our agri-food fund in Singapore. In terms of the support that they provide us, because of the size of their group and the breadth of the group, they've been able to make many introductions for us and to assist us with our business development. And we consult with them on a regular basis to get their insights about the direction of the markets and to ideas about how to take the company forward. I mentioned previously our portfolio company, SoulChip. SoulChip has an amazing new technology for reducing energy consumption in office buildings. They found that a small device that they've developed that represents a very low investment can reduce energy consumption in an office building by 50% or more. Well, the Libra Group owns more than 300,000 properties, primarily in the UK, and they're now in the process of introducing SoulChip, that is, to property managers throughout the UK to help us expand the market for that product.
And just a short point here. Chaim perhaps can remind us, the last 2 pipes that we did, both of which our controlling shareholder participated in a substantial way, were at more than 20% increases over the market.
Mhm.
So a 20% increase obviously is a substantial amount, and I don't think I'm breaking a confidence to say these were not difficult, arduous negotiations. These were discussions of value, and there was a great acceptance among the pipe participants, which they're more than just our controlling shareholder, in being willing to invest at substantially higher than market.
Sure, it's a good thing you asked us to keep our answers short. Can you imagine if you hadn't asked us to do that?
Exactly. This is what I'm worried about. Okay, here's another good question on investment strategies. In the sense of the companies, if we take into account that it takes a good 5-6 years to be established, another 8 to 10 years or more before exits are before a company is mature enough to exit. Will management look at investing into later stage companies at some point, or are we still going to be focused on incubating startups to tap into the co-funding from the Israeli Innovation Authority or equivalent in Singapore?
I think that at the moment, it's theoretical because we've suspended a new investment altogether. If and when we go back to investing, we'll have to think about what stages we invest in. One of the problems or issues with later stage investing certainly has the advantage of being closer to exits. and lower risk in the sense that in many cases, you're already past technology risk. You can evaluate management and how they perform more easily. But on the other hand, the valuations are very high. The amount of capital that those companies require is very large. And historically, we haven't had the sorts of capital that would make it possible to invest in late stage companies. Our Trendlines Agri-Food Fund in Singapore has invested in, I believe, 5 commercialization stage companies, and we're seeing great results there. And we believe that the fund will generate nice returns for the LPs and for the Trendlines Group as the GP. But that's a different investment model. And while I think it's worthy of consideration, we will have to see what kind of capital we have available to us before making a decision.
Okay, there's another question here, which is quite a long and complicated question, so bear with me. Food for thought for the management. A big-sized exit will move the needle in the share price more compared to an exit that brings in money over the next few years. Example, a 50 million exit on Apifix will move the stock price a lot more than having about 12 or 13 million for the next 4 years. Maybe we can have a combination of big exits and deferred payments. A, to increase the share price and pay dividends. 2, to have cash flow coming in future years to manage the natural cash burn when there are no exits. And 3, limiting the risk and exposure to execution risks of acquirers and also pulling of the product altogether by an acquirer due to a change in business direction, etc.
I couldn't agree more.
Exactly.
I couldn't agree more. I think we would love to have more larger exits. It's all a question of balancing. We have, and this even relates to the last question, because the more capital we have, the stronger our business model is going to be. And if we had $50 million exits instead of $15 million exits, we would have that capital. It would be available for distribution, but it would also be available for investment in later stage companies. Those later stage companies, by the way, could be our own companies, our existing portfolio companies, as they advance forward and get closer to exit. So I couldn't agree with the question more. And if anyone has any magic ideas about how we can achieve that, we're very open to listening, because we push our companies forward. We try to build them up. We look for the exits on the one hand, but we look for the optimal exits. And I think that it would be wonderful to see a $50 million exit proceeds. I mentioned earlier on that I believe that Phytolon could generate returns for us greater than our total market cap at some point in the future. But we have a ways to go before we know if that's going to be the case or not.
Okay, and that wraps up all the questions and discussion for today. Thank you very much to all of the people that signed in and listened in this morning. Just to finish off before 3 major holidays coming up or have already started, we'd like to wish everyone a happy Easter, a Ramadan Kareem, and Chag Pesach Sameach from wherever you are in the world.
Thank you, Sharon.
Thank you,
Thanks,
Sharon.
everyone.
Thank you, everyone.
Bye-bye.
Bye-bye.
Bye.